Hey everyone, and welcome back to another video for today. So obviously you've all heard that Charlie Munger has sold around 50% of his Alibaba's holding. Now if you don't believe me, you can just take a look at this thing right here. This is an official filing. You can see clearly Alibaba Group Holding Ltd, obviously sponsored ADS, 300,000 shares. Now he had way more than that, and again we can verify that. A negative 50% changes in share, down 302,060 shares. If you want to dig deeper, I did other videos about Alibaba where I showed you how many shares they were added, and now I can show you how many shares they were sold. So did the legendary investor make a huge mistake? Did he change his mind? Did somebody force him to change his mind? What actually happened there? Well, unfortunately, don't really have the answer to that question, but I can say one thing, that if you sold because Charlie Munger sold, then you should have never bought Alibaba to start with. If you bought Alibaba because Charlie Munger bought Alibaba, you shouldn't have bought it either. Now in my past video I explained why Alibaba just disregard the China risk for a moment. Obviously this is a huge risk, but we have some news on that front as well. But disregard the fact that it is a Chinese company, that the CCP controls everything that happens there. Just looking at the business, we can all agree that it's a tremendous business. Yes, it had its flaws here and there. Obviously, it had to pay a huge fine, but growth is also a bit decelerating. If you like the likes of JD, etc., they are actually continuing growing. So you could ask some questions, but overall, the Alibaba business, e-commerce, cloud, gaming, internationally, Chinese market, Taobao, Tmall, etc. They're all tremendous business segments, and if it was an American company, obviously I think everybody would own Alibaba in their portfolio. But because it's a Chinese company, and again, CCP, etc., then obviously I do understand why the majority does not own that stock. Maybe some own it, but it's just a tiny portion of their portfolio. But again, the business itself, it's a tremendous business. Can't lie, right? Everything they have there is expected to grow in the coming years. Now, obviously, I'm going to show you later on the various segments and how it has performed in the last quarter. But first, I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 free stock picks from their popular product, Stock Advisor. Now, Stock Advisor has beat the market by more than 4x. So all you have to do is go to fool.com/couchinvestor to get your free 10 stock picks now. First up, let's have a look at a couple of analyst price targets and ratings. So this was an article that came out last week. The average price target for the next 12 months is $176. Today, the price is a bit lower than $104, which means higher than 70% upside. If that ever happens, of course, because analysts and their price targets don't really matter that much today. It's just what they think that will happen in the next 12 months based on their research and their numbers that they've run through. Again, it's a nice point to see whether or not your research makes sense, but overall price targets can change over time. So here are some recent ratings provided by analysts. So first up, we have here a Citigroup analyst. She reduced her price target from $200 to $177, but she remains bullish on Alibaba for the long term. The reason why she lowered her price target is due to Chinese lockdown, due to climbing COVID cases. Hopefully this video doesn't get demonetized or whatever, which should affect Alibaba's profit growth in the near term. She predicts that the impacts of these lockdowns should extend into the first fiscal quarter and delay the recovery trend in the second half of the year. Then we have the second one from Goldman Sachs, who reiterated a buy recommendation and set a price target of $185. The analyst believes that the company's record high share buyback program will help improve Alibaba's balance sheet going forward. Then we have Barclays analyst was another bull, but at the time he had cut his price target sharply from $247 to $170. However, According to that analyst, the company's reported December quarter was in line with gross merchant volume and resilient when compared to the difficult quarter from a macroeconomic standpoint. And then the last one is from JP Morgan with a sell recommendation on Alibaba with a price target of $75. The explanation is due to high macroeconomic and geopolitical risks. Investors have been avoiding Chinese internet stocks, leading to pullouts by investment funds in which Alibaba was a key stock. Maybe this is what happened with Munger. I don't know. The analyst also thinks that the company's core business is under pressure thanks to high global inflation rates and a decrease in consumption in the Chinese market due to the recent lockdowns in the country. He expects this to compromise the short to medium-term outlook for Baba. So there you have it. I'll try to incorporate more analyst price targets, change of ratings and explanations in future videos, but at least now you've got one on this high risk, let's say, company because of the Chinese aspect. Now, regarding that Chinese risk, we actually had some news more recently. So regulators in China proposed changing a rule that prohibits non-Chinese agencies from reviewing company audit documents, which is something that obviously that's one of the major parts of the risk. We've seen that with Luckin Coffee, for example. This could mean that China could be on its way to cooperating with the Holding Foreign Companies Accountable Act, which requires any foreign company listed on US Stock Exchange to have their books audited by US agencies within 3 years as a condition of staying listed, which, if you think of it right now, it's crazy that this is not happening today and this has not happened in recent years. I mean, how is that even possible? And now with regards to Alibaba's last quarter. So they've reached 1.28 billion annual active consumers. Globally, they've grown in China 50% year over year, internationally 37% and globally 19%. Now, internationally is something that probably a lot of people do not really look at, but Alibaba internationally, which means outside of China, are pretty big, and 37% growth is pretty nice, especially if you think that 2020 was already a year of e-commerce growth. So to top that again, 37%, quite nice. Now what's very interesting, and those are the topics I talked about in previous Alibaba videos, is the China commerce retail. See, in China, Taobao, Tmall Supermarket, and Freshippo. So with Taobao and Tmall engagement and retention, next year retention rate is 86%. Taobao Deals, which has had a tremendous year, the annual active consumer reached 280 million, that quarter over quarter net adds of over 39 million. And then I won't even try and pronounce this name, but the percentage of this thing right here, annual active customers that were first-time fresh produce buyers on our platform, is up 50%. And then the cloud segment of the business. I've talked about that in the past videos as well. You can see here China cloud market from 2020 to 2025 is estimated to grow 5x. Now, an important word here is infrastructure. Infrastructure. This is something that the United States has still not figured out, and this is something they need to tackle as soon as possible. In China, they invest a ton in infrastructure, not in the financial system or whatever, but infrastructure, because as we've seen the past 2 years, infrastructure is king. And for the future, China is very well positioned on that front. So to conclude all of this, if you look at those numbers here, especially the year-over-year comparisons, you obviously see in here a huge decrease, right? Income from operations, it's down 86%, diluted earnings per share, it's down 74%. Now, yes, they have been investing in various segments of their business for future outcomes. Yes, they have been hit tremendously by their own government, by fines, by COVID, inflation, economic recovery that is a bit slowing down, etc. So do take those numbers into consideration, even though the business is a tremendous business, etc. There is risk, there is always a risk to it. Besides the Chinese risk, that's obviously a whole other story. From an investment point of view, again, you have to look at it both ways. From an investment point of view, it might be a tremendous investment 10 years from now. On the other side, the Chinese government. Do you want to give them your money? I don't know. The answer probably weighs to the no side of things. And with the potential change of American companies being able to audit Chinese companies that are listed in the United States, that could change a lot of things. If that happens, then I think a lot of people might look at Chinese stocks in a much different way. So overall, to conclude, Alibaba, tremendous business. The stock price is fairly cheap, right? If you compare it to American companies that are in the same segment, let's say Amazon, it's much cheaper than Amazon. But then again, there is the Chinese risk to it. Charlie Munger cut 50% of his position. The main reason, we don't know. Was he wrong? Probably yes, because he had a huge loss on that position. Now, let me know down in the comments below what you did with your Alibaba stock, if you own it, or if you don't own it, maybe you plan on owning it, do you short it? Let me know down in the comments below. And if you like this type of videos, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button, and I see you all in the next video. Bye bye.